There's a new biggest bull on Wall Street. Wells Fargo Securities' Chris Harvey upgrading his year-end S&P 500 target to a new street high of 48.25. That implies nearly an 8% gain from current levels. The new call coming on a record day for stocks with the S&P and NASDAQ closing at all-time highs. Joining us for now is Chris Harvey. Chris, great to have you with us.
Good to be back, Melissa.
What has happened to the backdrop to make you this much more bullish that you didn't see before?
Well, Melissa, there's really three things. So in the first half of the year, we knew we were too conservative, but we never had a hook. We didn't really understand how strong things were going to be. So we wanted to see 2Q numbers. And when we saw 2Q numbers, 2Q guidance, we knew that numbers could continue to go higher. And then we started to do the research. The thing that got us, and this is probably the most important thing to take away, we went back 31 years. 9 out of 9 times when the equity market was up 10% or more in the first 8 months of the year, every single time the market continued to go higher. Sometimes as little as 1%, sometimes as much as 13. Funny enough, on average, 8%. And we thought that was very important. That helped us get more bullish, besides the numbers and the belief that numbers are going to go higher and the fundamentals are still rather strong.
You do think, though, that there's going to be a pullback in the next year?
Yeah. So we think this is the part. So typically what you see is in the first year of the recovery, which is what we're in, you see very strong markets. Interestingly, when it's the first year of a presidential cycle, you also see very strong markets, which is what this is. However, in year two of a recovery, we often see multiple compression. Numbers still go higher, growth is still good, but you see multiple compression. We combine that with the belief that by the second half of next year, we're going to see monetary policy become less accommodative. We'll see tapering may be done by the second half of next year, and we may be staring at interest rate hikes. So you combine that all together, and we can see multiple compression. And so we think there's a melt up toward the end of this year, but there's a little bit of a hangover next year, and we can see a bit of a pullback.
You mentioned your research in terms of the, at month 8, if we're up strongly, I think it was 9 out of 9 times. We finished the year higher. Did it change from the 7th month? And how much tighter does it get 10 months in or 9 months? And I mean, it just seems interesting that you're like, okay, at 8 months, we're going to say this many times. I mean, the closer you are to the end of the year, Chris, the better the read on the year is going to be.
No doubt about it. But that doesn't mean that equity markets are going to go higher. And what the takeaway is, we kind of say it in a number of different ways. The rich continue to go to the rich. What's happening? We have excessive monetary and fiscal policy on the table. We've seen that in other years. We see that in the first year of presidential cycle. It all makes sense. The other thing that we're talking about is we believe numbers are going to go higher. And the reason being is that the uncertainty about the economy, it's not so much demand side, it's the supply side. And the supply is beginning to work itself out. The kinks are beginning to get worked out. And that means, hey, we have price, we have volume, numbers or earnings can go higher. And that, what we've seen this year is price follows earnings. We've seen S&P revisions up about 20%. The market's up about 20%. So if we're right, we see another mid to high single digit EPS revision. And that puts us squarely into mid to high single digit returns for the rest of the year.
Hey, Chris, it's BK. So I'm curious how this unfolds, because if everybody's thinking that the Fed's going to raise rate and the Fed's going to taper, then wouldn't the market start to price it in now? Why would this time follow the other? I mean, the Fed has been more transparent than they have in a long time. So why would this time follow that pattern? It seems to me it would just be priced in today.
So BK, it's a great question. And I'll bring you back to, I think it was 2004, 2005. I remember Greenspan saying this, and I was scratching my head at the time. He was saying, as we start to take off, as we start to raise rates, there's still excessive monetary policy on the table. Even when we start to taper, and we haven't started to taper, and we do start to taper, they're still buying bonds, you're going to have more monetary accommodation than you almost ever had in the entire history. It's going to take a while for that to come off. And so it just doesn't turn overnight. The other thing that's happening is QE, in my opinion, and many other people's opinions, has repressed bond, has pushed bond yields down, and has helped flatten the curve. And a lot of people take that as a signal, oh, the economy's slowing down. We don't think the economy slowing down is temporary. We don't think the bond market signal is the traditional signal you typically get. And so when we see things normalize, we think that could be very helpful for the reinflation trade.
And your top sectors are banks and capital goods. Chris, great to see you. Thanks for your time.
Thank you.
Chris Harvey, and you can read more about Chris's big call on CNBC.com/pro. So Chris sees another 8% upside for stocks before the end of the year.